Good morning, good afternoon, everybody. Welcome in. We are opening up today's energy transition webinar in just a moment. I see that the participants are just kind of trickling in, so give us 30 seconds. Our panelists are ready to go, and we're very excited about our first e-dialogues of 2021. We'll start in just a moment. All right. Again, just another couple of seconds to let our attendees come in. We're very excited here at Energy Dialogues to be hosting and having these fantastic panelists. And of course, thanks to Sempra LNG and to BRG Energy and Climate for sponsoring today. Being that it's 11:01 and I love being prompt and we have so much to take care of, I know people will continue to be coming, but let's kick this off. So I want to say again, thanks. And Energy Dialogues is here in collaboration with Sempra LNG and BRG Energy and Climate for today's e-dialogues, Energy Transitions and Decarbonization, a Global Perspective. We are so excited to be joined by our speakers today and plan on providing you with a full hour of valuable content, followed by a chance to engage and ask some questions. Please note a few things. Questions that were submitted ahead of time were sent to the panelists and may be incorporated in the dialogue a bit. If you do have questions today, please type it in the Q&A box and our moderator will interweave it into the discussion or address it at the end. That said, if we do not get to all questions today, know that we intend to continue the conversation at more e-dialogues throughout the year, and of course, at our this year's North American Gas Forum in November. Very briefly, if you don't know us, Energy Dialogues provides world-class platforms for progressive collaboration across the entire energy value chain and has a global alliance of energy leaders in its network. We have plans for this year that I will share at the end as to not take up any more time before we start this valuable discussion. I'll now hand it over to Lee Beck. Lee, please take it away.
Fantastic. Thank you so much for the introduction, Benna. Thank you so much, everyone, for joining us for this important discussions to provide perspectives on the energy transition and decarbonization from the Americas, the European Union, and emerging markets. My name is Lee Beck. I'm the Carbon Capture and Policy Innovation Director at the Clean Air Task Force and a Senior Fellow at the Atlantic Council Global Energy Center. The Clean Air Task Force is an environmental organization based in the US and Europe with work globally, and we're focused on climate-forward innovation technologies such as carbon capture, hydrogen, methane and super pollutants control, as well as geothermal and nuclear energy. It's an honor to be here today and discuss this outlook of the energy transition with my esteemed panel. I think this is an extremely relevant discussion, particularly against the background of the new US administration and of course a reinvigorated push for international collaboration on climate action and net zero emissions. So today we're going to talk about decarbonization initiatives globally. We're going to talk about environmental, social, and governance, as well as infrastructure needs and the role of natural gas and innovation. Benna already mentioned it. We received really fantastic questions from you, the audience, beforehand. And we would love for you to contribute more questions as we go. We'll try to incorporate as many as we can. I'm also encouraging you to submit any questions or tweet at us at @energy_dialogue with the hashtag #JoinTheDialogue. And without further ado, I'd like to introduce my panelists today. Thank you so much for joining us. We are so happy to welcome Brian Lloyd, who's the Regional Vice President of External Affairs at Sempra LNG, Chris Goncalves, Chair and Managing Director at BRG Energy and Climate, and Bobby Quintos, who's the Managing Director at Delta Offshore Energy. And we will start with Chris today, who will give us provide us a short introduction to a new BRE Energy and Climate paper titled From Resource Scarcity to Energy Abundance and Infinite Supply, the paradigm shift being wrought by the energy transition. Chris, the floor is yours. You're muted.
Thanks very much. For purposes of the introduction, I put together a few slides. Perhaps we can get those on the screen. Let's go back to the beginning. Hopefully everybody can see these okay. I've just selected a few slides from this recent white paper that was recently published. It's available on the Petroleum Economist website, will soon be available, I think, also on the BRG website. Happy to provide a copy to any interested parties if it's not easy to get your hands on. The topic of that white paper is from resource scarcity to energy abundance. And it refers to the paradigm shift being wrought by the energy transition. I've just selected a few kind of impact slides from some of the results to frame some of the discussion that we'll have here today. Disclaimer from our legal team. Sorry, slide 3, please. There's two major sections. First, just a summary of the energy drivers of the energy transition, the economic drivers of the energy transition, and then some of the results of our net zero scenarios for natural gas and LNG. There's a lot more there. I'm just going to summarize some of the key points, particularly focusing on impacts for natural gas and LNG. Next slide. So we all know fossil fuels are a bedrock of our society. There's just no other way to put it, and they will probably remain foundational for a very long time to come. The world's most advanced economies are the world's biggest energy consumers. That's well known. But tremendous economic growth has come at the expense of releasing increasing volumes of dangerous greenhouse gases. And decarbonization faces major headwinds. If you look at the graph on the left, you see the very tight correlation between global energy consumption since 1800 and global anthropogenic CO2 emissions. And you can see two things. One, that they track each other very closely, but also that CO2 emissions have begun to run ahead of energy consumption in terms of growth rates. And what that really shows is that we're becoming more carbon intensive in the way that we're using energy, obviously, over time. When you look at the chart on the right, quite important, when we think about the major target for getting rid of greenhouse gases in the power sector being coal, you can see that North America and Europe have already come a very long way, as recently as 2019, getting to the point where natural gas was either on par or significantly above the consumption of coal. Very striking in North America, how far we've come in shifting from coal to gas. Europe also making that transition very quickly. But look at Asia, just an enormous base of installed coal capacity relative to gas. Gas very much underrepresented. And in all of these regions, renewable energy still being very small. Europe is probably in the lead by and large with renewable energy, but frankly, renewables are still, although growing very quickly and leading the way in terms of annual installations, just far behind coal and gas. So you can see the challenge that's ahead, particularly in Asia. The other point about Asian coal-fired capacity is that on average, the installed units are about 11 years old, whereas a lot of the European and North American facilities are many decades, if not multiple decades old. So it's easier to phase out an old asset than a brand new one. Next slide. One of the main points that we've been making is that the economic foundations for the energy transition are already well established, taking hold and driving the wagon of energy transition on their own, even before we implement substantial new climate forward policies in North America and the Green Deal in Europe. This is a transition that's happening. It's happening right before our eyes. It's been going on for over a decade. And it's going to continue going on. Really, the question about future policies is about the speed of change, not about the direction of change. The direction of change is well established and ongoing. You can see in the chart on the left, the levelized cost of electricity and fuel prices in the dots. The lines represent the LCOE, or the levelized costs. And what you see in that gray range at the top is a full range of coal-fired generation costs at recent coal prices. You see the coal prices in the black dots. In the blue line, you see recent gas-fired generation costs, and you see the gas prices historically in the blue dots. And then at the very bottom in green and orange, you see the various kinds of wind and solar technology, which are at the very bottom. And it is that economic advantage that even without major incentives or carbon prices and so forth is really driving this transition, and will continue to drive it up until the point where we bump into the need for more storage than we can put in place economically, if that ever happens, before storage costs come down. This is going to keep driving the way. 2019 and 2020 were bumper years for the installation of renewable energy. There were some effects, supply chain effects from the pandemic, but we just keep putting way more renewable energy in place than any other kind of generation technology. Another major factor that gets perhaps not enough attention is the cost of debt for oil and gas and renewable energy. You see the green line representing renewables on the left and the blue line representing oil and gas. It's a weighted average cost of debt for the sector using kind of a proxy group we developed. But you can see, the cost of debt is down overall. That's been helping, energy investment, but it's particularly down for renewable energy, and it's sometimes by a great deal more. That is also, for a capital intensive industry that's basically all CapEx and debt cost base, very limited O&M, that is a major driver of the economic success of renewable energy. And it shows investors' preference for that technology. So we've got a bit of a snowball where the investor preference driving down the cost is improving the economics, is then driving the investor preference. It's a circular virtuous cycle. Next slide. And this is what I was talking about with the virtuous cycle. We've got also essentially infinite renewable energy supply coming from various natural sources, the wind, the sun, hydro, perhaps increasingly in the future, waves, geothermal. Basically, there is no commodity cost. It's free. And that energy is reducing power generation costs. That in turn is increasing electrification and demand. You've got electric vehicles, you've got new applications, cheaper power leads to more consumption. That in turn leads to increased scale economies, and that leads to technological maturation and efficiencies. We've already seen a cycle of this over the last decade, and we're going to see a lot more of it, especially when it comes to storage and green hydrogen and things like that in the future. So it's really setting off a virtuous cycle that's kind of self-propelling at this point. Just a few facts. We've estimated over the next 15 years, looking at the Biden plan, that for the US, there'll be about $2.3 trillion of additional CapEx required for all the renewable energy and storage investments needed to get to net zero power. But what's rarely talked about, you have to take out then the cost of the fuel that we would have otherwise consumed for that energy. We've modeled that, year by year over the 15 years. And estimated a $1.3 trillion in fuel cost savings. So the net incremental cost, net of the fuel savings, is 1 trillion. We've got no cost of carbon or anything in here. And when you do the math on that 1 trillion, it looks like about a $22 per megawatt hour levelized cost increase, which is about a 21% increase to retail energy rates, recent retail energy rates. Significant, but not extremely scary, and something that can be managed with policy, of course. And also I would point out that once that investment transition process is over, then the fuel savings just keep racking up, and the amount of investment sort of falls down from all new greenfield investment toward more like 20-year replacement cycles for infrastructure. Next slide. Just a couple of scenarios that we've looked at. We've got one sort of baseline, which is the EU net zero scenario only. That's kind of, that policy's in place, so we're assuming that as sort of base case. And then we've got a global net zero policy scenario, which may, one could argue whether that's becoming base case or not, but that brings in, North America, all of the Biden policies, as well as new ambitious targets coming from the JKT markets, Japan, Korea, Taiwan, and also some slower action in the other Asia economies moving on a more slow trajectory. And I'll give you some of the results of those two scenarios. We've run this through our global gas model to see what the impacts are. Next slide. I think the first thing to say is that, gas does take a hit, and it does decrease in terms of volumes of demand, but it's a shift down, not a decline. It's still a growing fuel that's in demand, really to manage the transition. You look at the chart, and you can see that on the chart on the left. You look at the chart on the right, and you see sort of winners and losers in terms of demand. And what's striking is really there's more demand growth in a net zero in the emerging Asian economies, China, India, Southeast Asia, et cetera, to manage the retirement of coal and the phasing out of dirtier energy before renewable energies can really kick in a more massive scale, maybe in the 2030s, 2040s. Whereas the declines in demand are coming, as you would expect, in North America, Europe, a little bit the Middle East, and a little bit of JKT. So the real big story here is Europe and North America in decline, most other markets going sideways, and big growth in gas demand in emerging Asia. Next slide. What this means for trade is also very interesting. And it's not as consistent a picture as you might think. We see at first that global LNG exports decline a bit for a few years, but then due to this Asian demand that I described, it actually increases, so that the amount of LNG exports grow from the mid-2020s through the end of the period in 2035. The reasons for that and those differentials from that EU base case can be seen on the chart on the right. You see in the early years sort of a decline of exports coming from the east of Suez and west of Suez producers. The North American producers kind of very much going side by side. And then on the chart on the right, you see substantial growth coming from North American exports in particular, but also some of the other west of Suez exports. Those are going to be mostly destined to the emerging Asian economies. And I don't have a price chart here, but I'll just say quickly in concluding, one of the big impacts of this is to reopen the Asian price premium, where, as you can imagine, because of these supply and demand dynamics, Europe and North American prices are under pressure, whereas Asian prices are actually improving relative to the others, and you go back to a more substantial Asian price premium in the LNG market. So I'll leave it there for now and look forward to your questions and further discussion.
Great, fantastic. Thank you so much. And for everyone, I'm already seeing in the Q&A, Chris, if you could be so kind and just in the chat, post the link to the study or the paper. I think that would be very helpful for our audience. Let's continue our dialogue. So Bobby, let's go over to you. I think there were a lot of interesting information about emerging markets in Chris's presentation. And of course, some American policymakers, and it has also recently been pointed out that, even if advanced economies make climate progress, it's important to bring along emerging market. That being said, of course, advanced economies need to decarbonize as soon as possible and make sure that we're commercializing the technologies so we have them available at least cost. Can you give us a little bit of an outlook where the energy transition stands in emerging markets, especially Southeast Asia, and what the opportunities and challenges are, and what you think will be important over the next, say, 5 to 10 years?
Great, thanks, Lee. And for those people listening in, just a quick background. Delta Offshore Energy, we own a project in Vietnam in the Mekong Delta. It's a 3.2 gigawatt power plant with an LNG terminal. So having said that, our focus, the company's focus has looked at the emerging nations in Southeast Asia, the Philippines, Indonesia, Vietnam in particular. And we're very keen on bringing LNG, exported LNG from the United States to this region. As Chris had in one of his slides, you can see that the demand growth is going to be higher for LNG in that region, specifically China, when they're trying to move away from coal. You saw that chart where the coal is just astronomically high. that'll take some time to transition over. But I think if you focus on the Southeast Asian nations, they're more keen to move away from coal as fast as possible. And because their current demand is not as large as the Chinese demand or the India demand, it'll be easier to transition. And that's what we're focused on. Our plan, our power plant originally was actually slated by the Vietnamese government as a coal plant. And they made the decision to move away from coal right away and transition over to natural gas. So a lot of potential there. The United States, even with the new administration, there was a roundtable with US Exim actually on the 18th of January, where they specifically said that Exim is looking at providing support for LNG exports. So that in general, I think is not going to change even with the new administration in place. So very exciting times for Southeast Asia, a lot of potential there. And our Vietnam project is a good example of that with the way how quickly it's moving forward.
Perfect. Thank you for this insight. And I do want to pick this up in a little bit after we've heard from Brian, because yesterday or today, it was the European Union ministers made an announcement that they're encouraging all investments in unabated oil and gas infrastructure in non-EU countries to be discouraged. So I want to hear your perspectives on what the future is and how innovation might be able to help us decarbonize from that perspective. So Brian, let's go over to you. How do you think about the energy transition at Sempra, both in the US and of course on an international level? And maybe if you could also reflect a little bit from your perspective on what we've heard already, that would be really fantastic.
Yeah, you bet. Thanks, Lee. And I'll again try to be a little bit brief here because I think Chris and Bobby did such a great job, and I'd rather get to your questions. But for those of you who know Sempra, we're an interesting company because we have both domestic U.S. utilities, natural gas distribution utility in California and electric utilities in California and Texas, as well as our growing LNG business with operating, under construction, and in development projects on both the Gulf Coast and the Pacific Coast for access to Asia. Then we have a Mexico business as well. And we can often get the question of, well, that's a weird mix of businesses these days to have together. And we actually view them really as all the same type of business. They are all infrastructure businesses that solve one of the critical problems of this transition in moving abundant, lower cost energy into areas where the demand growth is or where consumers are. And that's true both domestically as well as internationally. And so just, I think macro level, we think the trends that sort of Chris laid out are very much apparent. They have been apparent in the US. The US over the last 20 years has reduced greenhouse gas emissions more than any other country. And in the power sector in particular, that's been this combination of coal to gas switching and then adding renewables into the mix. And it's, the time frame of these, in particular, as we talk about a new administration with goals at 2035 and 2050, I like to sort of bracket this sort of 15-year period before today and 15 years from now, and use Texas as an example, because Texas in 2005 was really when we started the process of building infrastructure to, again, connect these areas that had abundant wind and solar resources back to the eastern part of the state in Texas. California's gone through something similar, where their resources are in the eastern part of the state and the demand centers are increasingly on the western part of the state. In both cases, we have had to add significant transmission, and particularly in Texas, that has been what has driven the transition, in my view, as much as anything. Certainly, you've had tax policy at the federal level. We had a very small renewable mandate in Texas, but ultimately providing access to the market and access to the customers is what has really enabled the Texas grid to go from 40% coal 15 years ago to about 17% last year. And under the projections from the grid operator, and again, to Chris's point, no carbon taxes, no extension of tax subsidies, no additional renewable mandates. By 2035, it's going to be a power grid where the coal is basically gone. It's a very small amount of some newer coal plants, but is going to largely be the same, call it 35 to 45% natural gas system as we saw 15 years ago. And so gas is really, even in some place like Texas, stayed relatively constant as the wind and solar continues to come in and displace the coal. And so You have sort of over this 30-year period now, the projection that the ERCOT power grid is going to become 60% renewable, or I'm sorry, 60% carbon free when you account the small amount of nuclear we'll have left here as well. And so I think, you know, what you need for that, and again, what grid operators around the world keep saying is, and then we got to add a lot of transmission. And then when you layer in electrification, particularly in the transportation sector, you're going to have to add in distribution as well. And again, all of this is really fundamentally being able to move that lower carbon energy to where consumers want to use it. Our view is that LNG does this same thing globally. It takes abundant lower carbon fossil fuels, natural gas, in the US, as Chris said, it is at best flat, likely declining over the next couple of decades in terms of demand, and moving it to the parts of the world, like Bobby has said, that are reliant on coal today. And absent a global LNG trade, it's difficult to see how they can accelerate their decarbonization while at the same time they're trying to grow their economies, and 90% of the growth in electricity demand in the next 20 years is going to be occurring in these markets. And it's good for them for the same reason we're worried about decarbonization, because we don't want people to suffer, is the same reason we're worried about economic growth around the world. And I think one of the saddest statistics about the last year with pandemics and COVID is that for the first time in 25 years, we have reversed the trend of pulling people out of extreme poverty. And how much more critical is it now to make economies more resilient, more wealthy, and have better access to energy to be able to withstand whether it's pandemic shocks, whether it's climate shocks, and the rest. And so we really view in many ways the LNG trade as you can think of it like a global power grid in a lot of ways. Think of regas terminals. Think of liquefaction terminals as where your big substations, that's where you transform the energy and then you ultimately move it across the oceans to where it's needed into a power grid. I will say as a company, we are not one who views that renewable expansion and LNG expansion are in a whole lot of conflict with each other. We think they very much complement. And as you move away from inflexible coal plants to much more flexible natural gas plants, again, I think the experience in the US and in the EU is as you add that gas, you actually increase your ability to add renewable energy and not have disruptive grid events and the like. And so I think, you know, our view is that the infrastructure really is the key link. It's likely to be the binding constraint, quite frankly, both in the US and in Europe, as well as around the world, is getting this infrastructure built. In Texas, we took, you know, significant amount of time to build a large amount of renewables, for transmission for renewables. In California, they took a significant amount of time to build even less, just because of the permitting process. And so as we excited about the conversation of what a new administration might do to really accelerate the adding of this infrastructure that, again, will increasingly link global markets in this kind of coherent, decarbonized, electrified, but with natural gas continuing to play an important role for decades to come, including US LNG. And so Lee, I'll turn it back to you from there.
Yeah, perfect. I think you touched on very important points here. You mentioned how policies in the US really helped us build out renewables, but I think the consensus is that this is no longer enough. So the first part of my next question to the panel is, what do the next generation clean energy policies look like, in particular against the backdrop of a massive, potentially massive infrastructure green stimulus package in the US? What do those next generation infrastructure policies look like? And then on the second part of this question, how does it touch on natural gas? You're saying, you talked about the EU and natural gas, where, to be frank, it's coming under a lot of pressure there as an unabated fuel. So how are you going to take care of the CO2 emissions from natural gas? What is the innovation on the horizon? A lot of the audience questions were about hydrogen, so I'd love to hear your thoughts on this, but also what's coming, gaining a lot more attention since the last administration undid the rules on methane, are methane and super pollutants. So I'd like to, I know this is a big set of questions, but this is, I think, where we'd like this conversation today to go towards. So yeah, I am just going to go back to Chris. We're going to go full circle, and yeah, would love to hear your thoughts on next gen policy infrastructure. You're muted.
Sorry about that, forgot. Those are great questions, obviously very challenging, and that's a lot of material actually. Let's see, first, I think starting with gas, just to be clear regarding the forecast I gave and also what the policies are aiming at, we are talking about both in the EU and in the North American markets, particularly US right now, about net zero power, which means essentially no natural gas or no natural gas without corresponding CCUS, carbon capture. So that essentially means getting rid of natural gas for power. That means less gas demand and more available gas at lower prices probably for LNG export. That's our view. If we really go the full, distance toward net zero power, but there's a big contingency in there about the economics and availability of storage. We can have a lot of complex debate about those cost economics and an availability of all the minerals and resources needed to produce all those batteries and the volume of storage needed, green hydrogen, etc. But that's the goal, and it does mean no natural gas for power generation. And that really does take us to green hydrogen and other clean fuels. And I want to bring in Asia as well, because with all that coal, what they're talking about is not net zero power, but they're talking about co-firing with ammonia and coal plants to reduce emissions. Well, there's another natural gas derivative product that would be used with coal to manage the transition. If you put 60% ammonia into the coal mix, you can get the emissions from a coal plant down, with an average heat rate toward the emissions from a natural gas plant. But that's an expensive proposition. So there's those kind of solutions. One point about green hydrogen I'd make quickly, since you wove that in there, is that one of the best things for the cost of green hydrogen, based on electrolysis, using electricity as the main input cost, and the cost of electrolyzers being the other major capital cost, is reducing the cost of power. So the green energy revolution of taking the fossil fuel costs out of power generation and bringing power generation costs down over the very long term will ultimately benefit green hydrogen as a clean fuel by cutting electricity costs and therefore the cost of producing green hydrogen from electricity, from green electricity. But that's not going to happen tomorrow. The costs are probably going to go up before they go down. And so that's why we're viewing green hydrogen as definitely a priority solution and something that's coming fast for policy reasons. But the true kind of competitive economics of green hydrogen are probably a decade away or more. So I don't know if I covered all your points, but there's some quick thoughts there.
Great. Yeah. Bobby, do you want to jump in here next?
Yeah. So as we kind of discussed before this, the policies out of Southeast Asia, and I'll talk from that perspective, and the emerging nations, the Africa, South America, et cetera. The policies now that we're seeing in the United States and European policies for net zero, those are first world policies, right? Those are nice to have because the economies are strong, they have existing infrastructure in place, and they have the wealth to actually pull this through. When you look at the Southeast Asian countries, even if you look at China and India, and that's always been the stress point there with the Paris Accords, right? Is they want to grow their GDP and they want to get to that first world status. And the only way to do that is to have energy. That's just the bottom line. They don't care where they get their energy from or to get their electricity from. It'll be from coal if it's available, from gas, et cetera, et cetera. So you're not going to see any policies coming out of these countries, out of the Vietnams, out of Indonesia's, out of the Philippines, out of Africa's or South America saying, we're going to go net zero also. That's just not practical for them if they want to keep growing their economy and pull their people out of poverty. But having said that, I just want to point out what Chris said earlier, and you can see it happening actually, if you look at Vietnam as a case study, the same thing that happened in Texas. The natural gas plant that we're building now, and what we need is a 500 kV transmission line to sell that electricity, the electrons, actually enables a lot of renewable projects in Vietnam. The reason for that is because a lot of these renewable projects are smaller. They're 40 megawatts, 35 megawatts wind, PV, et cetera, but they're not enough to justify large transmission lines, right? To make economies of scale. However, because we are putting in a baseload plant with this transmission line, they can piggyback their projects onto that 500 kV line that we're building. So that actually enables, and a lot of the renewables, which is actually, if you take the aggregate number of all these renewables that our project's going to enable, it's going to be in the gigs, 3, 4, 5 gigs actually. So by happenstance, it actually is good that we're bringing in, we're going to be importing LNG into Vietnam, but at the same time, a positive output of that is actually the enabling of these renewable projects in Vietnam. So although there's not going to be any policy, you will see, if you just let the market play itself out, and it's funny to be saying that for a communist country, but if you let it play out, it'll adjust. I think people want clean energy, people want clean air. But if you leave it alone, I think it'll happen naturally. This is the way I'm seeing it.
Great,
Liam,
Brian, I think
I'm
you're
happy, yeah.
unmuted. You'd like to jump in? Yeah.
Yeah, I'm happy to jump in next. Look, I think, Chris's slides there, I think were very instructive when you sort of talk about what could a new administration do that's really productive to advancing this. As I sort of laid out, I mean, you're going to have record amounts of wind and solar energy in the US and the EU and places like Texas. And you're still going to have this big slug at the end of how do you fill in that last gap? And Chris mentioned some, I think things like carbon capture, all of the scenarios for how you get to net zero by 2050, you kind of get forced in there because it's really what you need to ultimately abate some of those, either the hard to abate sectors or again, maintain long duration storage, or even when it comes to hydrogen, I think my personal view is hydrogen is going to evolve very much like the power grid did. If you want a hydrogen economy, first thing you want is a lot of cheap hydrogen to kind of start to convince people to sort of move in that direction, continue to explore how you can blend that into natural gas distribution systems, continue to explore what's the limit that you can put in the power plants, or start designing power plants to be able to use a lot of hydrogen. And as Chris said, with ammonia, most natural gas or most hydrogen produced today is from natural gas. And looking at that with carbon capture on it, like there are some plants already in place today, you then, much like the power grid, the electrons are getting lower and lower carbon, greener and greener. I think you think of it in the same way. The molecules continually get lower and lower carbon, whether that's hydrogen, whether that's natural gas. I think, again, what's interesting to me is how these things start to come together. And you think about a very low carbon US power grid. Well, what that means is in places like West Texas or in New Mexico, you have oil and gas production that starts to become lower and lower carbon. Everything from frac fleets getting electrified to the production itself getting off of diesel gensets onto very low carbon power grids. You then, through the supply chain there, you start looking at electrifying compressors on pipelines. You get to LNG terminals and you look at those becoming both electrified and carbon capture for the CO2 removal. And you can start to see this ecosystem getting built that then ultimately when the LNG lands on the other side of the country, that again, the EU and maybe US have now led in the next generation of technologies being developed, carbon capture, green hydrogen, and the like. And over time, those start to get exported to those countries, or that knowledge and technology kind of gets there as well. So when it comes to policies of a new administration, there's a great bill, I can't remember the authors, sort of concept of, let's really put focus there. Let's put a lot of money towards seeing if we can rapidly mature these technologies. And then we get out to, at some point, and they're not there, then maybe you look at heavy regulation there. But when you look at things like extending existing tax credits for wind and solar, when you look at things like carbon taxes, again, I think the analyses are starting to suggest, other than maybe forcing coal out quicker than it's going to go out anyway by 2035, you're not really changing much of the investment decisions at this point. And so, given the political temperature around those things, you've got to ask yourself, is that worth a fight for us to have again when it's not really changing what people are building tomorrow? Again, it might flush a higher carbon resource out sooner, but when we get to 2035, you're going to be in the same spot. And we've spilled a lot of political blood over that, when instead we could be focused on these incentives for this next generation of technology. And let's rapidly develop them the same way we've developed wind and solar.
Okay, got it. So just to summarize, because we had a lot of ideas, we're hearing that we need advanced economies like the US, like Europe, take the lead and invest in low carbon technologies like they've done in renewable energy technologies to reduce the cost and make them available globally. So emerging markets can tap into the lower cost commercialized technologies. I think that was one thought that we heard. Another thought, what we're hearing is the pathway towards decarbonization, investment and innovation, like for example, the omnibus that was passed last Congress right around Christmas, suggested and is really being celebrated as a large down payment for innovation for lower carbon advanced energy technologies. And is there a need for more advanced, more comprehensive climate policy? I think, Chris, in our discussions before this panel, you mentioned the carbon border adjustment, which is all the rage in Europe right now and meant to strengthen the European emissions trading system, which is the European carbon market, which is, of course, right now trading roughly at 30 euros, so lower than some analyses suggest. So is there really a way around, this is a long way of asking you, is there really a way around more comprehensive climate policy in the US? Can innovation policies do it alone? Or would there be, for example, room for a clean energy standard? I'd love to hear your thoughts on this, as well as there's being made more pressure on US administration.
Yeah. Tough issue. I think I'll go not out on a limb, but I'll maybe be a little contrarian on this, because I think we are at a point in time where there's a really renewed sense of urgency, or maybe a new sense of urgency around this. And there is, despite all the polemics and the political polarization of the moment, there's actually a lot of consensus on this. I mean, if you look at real polling of Americans on their support for clean energy policies and ambitious policy, just as you look at polling in Europe, there's vast majorities of people, they don't know exactly which policy they prefer, but they prefer substantial, pragmatic by any measure, but pragmatic, but also progressive policy. And I think we are also, to be very realistic about what's coming in the Biden administration and what Europe is actually doing, I think you can kind of see the stars starting to align. Can you hear me okay? I just saw a chat that said lost audio, so I was worried that it got cut off. I think the stars are starting to align. You're getting quite a bit of alignment between what looks like a lot of the major U.S. state policies, the U.S. federal policies forthcoming, and a lot of the EU policies. So, speaking specifically to carbon tax and carbon border adjustments, I think we're coming to a moment where policy will begin to accelerate. I agree with Brian that the economics are going in this direction, and it's all going to go on its own toward a certain goal by 2035 or 2050. But I think probably politicians and governments are going to speed this up with some more ambitious policy. And I think nobody wants to be the first country or region to put in place an aggressive carbon tax, or a pricing system that puts a huge price on carbon. I mean, like a $50 social cost of carbon, or maybe escalating toward like a $100 number. But there's plenty of bills on the Hill and policies before people in Brussels to get to those kind of numbers. That would tip some scales and accelerate things quite a bit. It will also raise the cost of energy unless it's somehow refunded to society. And it also significantly increases the risk of carbon leakage, which means that you put these policies in place in your own country, you increase the cost of energy through carbon pricing, you increase the cost of industrial inputs, you increase the cost of your exports, and you lose in your foreign trade. I was on a webinar the other day, I heard a Republican politician saying, I don't know what this carbon border tax is, but I know we got to use trade if we're going to be putting in place any carbon taxes. It's intuitively correct that you either have to get everybody to agree to do it at the same time. How likely is that? Not very. Or put some sort of equal tax at the border on the imports coming in. That's where Europe's going. I think that's going to come up in US policy, maybe not next month, but within the year. And it wouldn't surprise me at all to see an Atlantic alliance on this topic And I know for a fact that there's, policymakers in Asia that are quite concerned about this, because it would obviously make, it would be like protection with principles. It would be protection, but not for protection's sake, but for the climate's sake. And, it's hard to argue with. So I think it's not the base case yet, but this kind of alignment of policies is actually becoming, if not likely, quite possible.
Great, thank you. Bobby, would you like to, given Chris touched on emerging market perspective in Asia, would you like to
Sure.
Elaborate on this?
So just to go back on Chris's comments on the carbon tax, again, if you look at the Southeast Asia area and East Asia, it's the fastest growing portion of the economy and the world, and it's going to be like that for quite some time. The population there is booming, and more so they're trading amongst themselves, right? So even and that economy itself is growing on its own. So even if you do put the border taxes in Europe and the United States, if your overall goal is to reduce greenhouse gas emissions, you can't have a major part of the world just ignore it and just continue to put out the greenhouse gases. So that may be fine for first world countries with the carbon taxes, but in the emerging countries, again, the Africas, the Southeast Asia, they're just struggling to make ends meet. They just want to get their GDP going up and going. So they're probably going to be the biggest violators of this, any sort of global policies, if there is one that does come out of it. Again, there has to be a better way than to just penalizing people for trying to get out of poverty. I mean, one of the biggest goals of bringing energy, affordable energy, specifically like LNG, to the east part of the world is the eradication of poverty. As the countries become wealthier, then they could focus more on cleaner climates. But until you get that tipping point to the place where they have good infrastructure in place and they are coming out of poverty and the GDP is growing, policies like that I think will not be very efficient in that part of the world.
Lee, that's a great point. Could I address that?
Yeah, absolutely.
Yeah, I will. That's a great point, Bobby. And I think there's also an element we haven't talked about here, but that is a big part of some of the policy thinking, both in Washington and Brussels, about climate justice and this issue of, making sure that, climate policies are fair toward underprivileged communities and countries and not penalizing them. But so who knows where that goes? I mean, but that's out there and it might start to be a part of the discussion. But the main point I want to make is that, not the emerging markets, I guess the smaller economies, these are not the big offenders with respect to carbon emissions. I mean, they don't produce enough carbon, they don't consume enough energy. I don't think they're going to be in the crosshairs of these kind of policies the way they're set up. I think really a lot of this policy might be aimed at, if it's aimed at anything in particular besides carbon, the impacts would be greatest for countries like China, like India, like the JKT markets, which burn an awful lot of coal, produce an awful lot of carbon, and export an awful lot of products to Europe and the United States. I don't see Southeast Asia, Africa, Latin America being big problems yet from a climate perspective. Yeah, they may have some coal plants and some dirty energy, but their overall volume of contribution to the problem is just not at the same scale as these other markets.
Thank you for providing this perspective, Chris. I do want to shift gears here a little bit, and I do want to remind the audience that we have 12 minutes left. So if there are any other questions that you'd like to ask the panelists, please submit them as soon as possible. And we got a lot of question on hydrogen before the event, and there's some more in here. Just to give a kind of global perspective on hydrogen, of course, the European Union is currently working on finalizing its hydrogen strategy, which includes both green hydrogen from renewables, but also blue hydrogen from natural gas with carbon capture and storage. And then in the US, we're seeing the conversation slowly evolve with first policy proposals in Congress, but especially overseas. Japan is looking to import hydrogen in from Australia, clean hydrogen from Australia. China is looking to scale up the hydrogen vehicle or fuel cell vehicle market. So where is it? And then there are these questions, and somebody asked this in the chat, is it really possible right now? What are the next steps to commercializing this technology? Brian, you touched a bit on it already, but I do want to drill a little bit deeper. Maybe we can start with you. And what's the potential? Where do you think we can be by 2030 with regards to the hydrogen economy?
Yeah, I'll take the first stab at it. You know, look, our family of companies are, again, kind of doing some pilots both on the green hydrogen space as well as sort of the ultimate blending. I saw a question in the Q&A around the impacts of hydrogen on the underlying infrastructure and systems. And look, again, I think these are the exact types of things that research needs to be done. I think it's why when you see some discussion about we shouldn't be investing in natural gas infrastructure, whether that's for safety or other reasons, I think that is short-sighted. I think that's myopic, because ultimately it's that infrastructure that, as we can upgrade it or do the things to it to make it be able to get more and more hydrogen in there, that's a good thing. And I think we're a company that doesn't think we're going to sort of pack up all the natural gas pipelines at some point. I think the question is really kind of how do we reuse those? So we really think that kind of stranded asset thing, and again, some of the dialogue around, you know, no more investments in this space because it's all stranded, again, I think is myopic as to what you can ultimately really kind of get to on there. Chris, I thought had some great points about where you look at the places where, again, renewable energy is going to expand, and we're going to be curtailing it probably at some time. Texas is a great example. California is already an example where the nature of the production is such that you may not have sufficient customer demand at that point. Now, you can build transmission networks, help that out, but again, ultimately in places like Texas, we're going to have more wind than we can use, and that's, I think, really where, again, advancements in electrolysis at some point, you know, when the wind is free or you get paid to take it because of ongoing tax credits, that again helps you sort of start to buy down that technology and do those things. So again, I think that's you know, what's the ultimate path on that? Again, I think it's hard to say, and I think it is dangerous to sort of put the eggs in the one basket of green hydrogen is going to be the savior for keeping power grids reliable, particularly as we continue to add demand to that grid. And again, sort of on the somebody in the Q&A I saw about a question about level LCOE. I honestly am one who thinks LCOE is an interesting thing to look at these days, but doesn't really tell you what you need to know for modern power grids. Again, because for those who don't know, I was an electricity regulator in Texas, so I default to that. But when you can look at the LCOE of wind power, but again, when it produces at a time that perhaps is not where your summer peak demand is, that doesn't necessarily tell you the right investment decision at that point, particularly if you're oversaturated in those hours where you produce the most. And it's been a thing, you know, developers have struggled with in Texas, and we've struggled to keep up with the transmission kind of for that. Again, are there opportunities there for storage? Are there opportunities for green hydrogen production? Yes. But again, I think that's where, again, a concentrated national effort of really investing in the R&D to bring down the cost of these can ultimately provide that long-term benefit of when we get to 2050, how do we solve this last very difficult slug of energy needs that right now it's not clear you can get there. I mean, I think Fatih Birol has said 50% of the technologies needed to get to net zero by 2050 don't exist, or they're not mature at this point. And so again, that's, I think, a place where both parties and all countries can kind of get to. I'll just sort of say on the last point, I think a retraction in free energy trade is perhaps the biggest understated risk to achieving decarbonization goals. I think if countries lock themselves into trade wars under the guise of carbon pricing, then I really worry about what that does for rapid decarbonization on the coal to gas switching, as well as development of these other technologies.
Great, thanks. Actually, it's 75% of technology emissions reductions by 2050 are expected to come from technologies not yet mature. And I think this is such an important number because it shows how imperative innovation is to decarbonization goals, and how hard the road ahead will be if we're looking at net zero 2050. And of course, keeping in mind the sooner we can reduce emissions, the better our chance at fending off our worst effects of climate change. Okay, I just want to ask Bobby and Chris if you have anything to add quickly on hydrogen, and then I want to get into a few more questions that I'm seeing pop up here. Would you like quickly to say something about hydrogen, both of you?
I have just technical, well, 2 points. One, there was a great question earlier, it's come and gone in the chat, but about the technical problems with hydrogen and the fact that engineers can't certify that the grids moving hydrogen and pipelines and so forth. I wasn't exactly clear on the infrastructure they were asking about, but I think it was directed at pipelines. That engineers can't certify the safety of it, and we know it's a very volatile and challenging fuel to work with compared to others. So I think that's a very good point, and it kind of goes to what Brian was saying about the need for advances in electrolysis. Obviously, Biden has put a big priority on investing in electrolysis, advanced electrolysis, trying to bring costs down. There's a lot of movement on that and investment on that going on in Europe from SNOM and multiple other parties. So I think that those advances are going to be made. But this thing about safety and also embrittlement of pipelines and how you move it. I mean, what we know now is you can blend 10, 15, maybe 20% of hydrogen. I think it's more like 10, 15 into a natural gas stream without too much additional investment. That can be done pretty safely, as I'm given to understand. I'm not an engineer. But when you start going to 100% hydrogen, you need to make substantial investments in pipeline safety. The other thing, though, just a quick opportunity point, the US is really interesting here with respect to the role of hydrogen for energy storage and electricity generation, thinking more long-term as we shift away from fossil fuels. We have such a tremendous resource here that no other region I'm aware of on Earth has, which is salt cavern underground storage for natural gas. And I'm given to understand, not too much additional investment, these facilities can be converted to safely storing hydrogen underground. There's a project we've worked on for one of the participants, one of the stakeholders in Utah, the Intermountain Power Project. There's now Mitsubishi talking about, electrolyzing hydrogen, storing it underground, bringing it out at night, producing electricity, sending it to LA when the sun doesn't shine. This kind of time of day and seasonal, power generation for firming using green hydrogen produced by excess renewable energy produced when there's not enough demand, time of day, seasonally, is really quite interesting operationally. And the US could pull it off with all that storage capacity. It's really just a question of cost. So, you could see a future of that.
Great, thanks, Chris. Bobby, I want to go to you quickly. And then if there's also a question I think that would be great for you. And this is, what's your perspective on carbon neutral LNG from the US to Asia, and carbon neutrality being achieved through purchasing offsets, which come, of course, with their own problems from an environmental perspective. So yeah, I want to pose this question to you as well, Bobby. And then unfortunately, we have to wrap up.
Yeah, we only have
soon.
Minutes left, but I fully agree with Chris. The technology is very difficult for this hydrogen, very, very explosive, and hydrogen embrittlement is a very big problem. So you need a lot of exotic metals to actually work into your infrastructure, which is going to be very, very expensive. Carbon neutral LNG, that's a good one. I think sometimes when I repeat it in my head, it sounds like an oxymoron because natural gas, inherently has carbon in it. But I know what they mean by carbon neutral when they saying, the upstream stuff, but it's just poking fun at them. But I don't think it's going to be that much of an impact. If anything else, it'll take time actually to determine which fields are more carbon neutral that they're drawing the gases from into the liquefaction facility. So that's going to be a little bit challenging. That needs a little bit more work. But in the short term, I don't think there's going to be a large impact on that. As far as exports of LNG to the emerging markets.
I'll hit real quickly. I mean, I do think we think part of the path here, to Bobby's point, is ultimately as different technologies and measurement systems are formed, something analogous to sort of a renewable energy credit market in gas, and whether that's a certification of suppliers, whether that's some type of down the road continuous monitoring to where, again, you can sort of have some attribute of the methane intensity of the operator or something like that, ultimately is a way to distinguish the product in the marketplace. In the same way, again, electrons have gotten this distinguishing characteristic through a renewable energy credit. There's no reason you ultimately can't come up with something like that in a sort of a rough way to something kind of even more precise. And that, again, does create an opportunity for I would say a lower carbon LNG to really get it distinguished and advantage in the marketplace.
Perfect. Thank you so much. And we're on top of the hour. So I'd like to thank the audience for joining us today, being very active with questions and staying on with us for the full hour. And of course, our panelists, I think we've heard really an insightful conversation around the energy transition and decarbonization and how we're going to probably achieve net zero emissions at different speeds and with varying technology portfolios across the world. Thank you so much, everyone. Benna, I'm going to hand it over to you.
Thanks, Lee. And thank you, of course, to our panelists and sponsors today. The last hour will be available on demand. So for anyone that came late, or if you want to review later, the full recording will be accessible at your convenience. I know we could continue to just discuss this topic much longer. Of course, there's questions that we would love to get to. And as I mentioned before, stay tuned for information because we will have another panel and interactive discussion at the next e-dialogues. Speaking of coming up next, let's see if I could technology this situation here. Hopefully you're all seeing some of our dates. I want to share a few upcoming event dates with you. Those of you that are already members, you may have joined previously for our monthly energy hour, where we get together and discuss the latest trends over a glass of wine, virtually, of course, for now. If you are not a member and want more details of how to access the Energy Hour, as well as these fantastic content e-dialogues, don't hesitate to contact me or anyone at at Energy Dialogues. Our next e-dialogues will be on the future of US and Mexico relations and its impact on the energy industry on February 23rd. Information about this event will be at our follow-up email. And of course, our forums throughout the rest of the year. Do note we are keeping a close eye on the CDC and safety regulations, and we'll have updates to the virtual, hybrid, in-personness of these upcoming events. I want to say thank you again to our attendees, to our panelists, to our sponsors, Sempra LNG and BRG Energy. Thank you for joining today. It was fantastic, and I look forward to continuing the dialogue soon. Till next time. Bye, everyone.
Thank you. Bye-bye.
Bye.